Hi there, it's me, Stephen Thomas, with Reports on Housing with another housing debrief. But first, I'd like everybody to quietly tap the like button and also to quietly subscribe to our channel so that we can get this great information in front of as many people as possible. And unfortunately, the only way to do that is by liking, viewing, and subscribing to our YouTube channel. So I'd appreciate you guys doing that. Let's talk about a SoCal housing update. But first, I want to thank our sponsor. It's justappraisalsinc.com. Just Appraisals Inc. They do residential valuation at 949-939-5622. That's 949-939-5622. And they have a leading real estate appraisal company with over 20 years of experience. They're based in Orange County, serving OC and surrounding counties. They have a team of highly qualified and experienced appraisers, a systematic approach towards appraisals, providing high quality and a realistic value to your property, and exceptional service and competitive fees. And they also do estate planning, date of death appraisals, divorce appraisals, complex residential pre-listing appraisals. So have them work for you at justappraisalsinc.com. Just Appraisals Inc. 949-939-5622. That's 949-939-5622. And now back to the program, a SoCal housing update. We need to talk about rates because the direction of the housing market really has a lot to do with rates. We've actually talked about that before. And now the debt ceiling is working its way into the housing market, at least in terms of rates right now. We're not seeing a big change in any of our data. The only thing I'm hearing is anecdotally a few, we have multiple offer situation, but now there are fewer offers than there were maybe a couple of weeks ago. We'll have to see if that continues. But we're also going into the summer market, which is a transitionary market where we go from the most robust time of the year to the spring market. But we'll get into that in a moment. Interest rates from the debt ceiling have actually, within the last 2 weeks alone, have gone from 6.49 to 7.12%. That is a pretty big jump in just a couple of weeks. And you can see it with that orange arrow that we've actually right now at 7.12%. We were at 7.10% back in the very beginning of March for a minute, and then very shortly thereafter there was the banking crisis with SVB Bank and the other banks that folded, and then interest rates fell. They fell to a range, and that's where those black dots are, between 6.5% and 6.75%. Pretty much stayed right within that range, but recently has popped above that range and continued to go up, and that has everything to do with this debt ceiling. There's nothing really extra that has happened with any of the economic news that should make it fall or increase from that range that I talked about, 6.5% to 6.75%. It's kind of there, 6.5% to 6.75%, until finally somewhere down the road, something's where the economy slows down and it shifts a little bit more, and we'll see interest rates fall a little bit more. That is most likely scenario as to where we are going. But this is actually the highest rate, and you have to go all the way back to the last time we were here, and that was in November. So this is the highest rate. And what's interesting about that is the 10-year Treasury. The 10-year Treasury, there's this love affair between the 10-year Treasury and mortgage rates. And when 10-year Treasury goes up, mortgage rates go up. When 10-year Treasury goes down, mortgage rates go down. And this has happened for the past 50 years plus. And if you look closely, you can actually see that right now, I'm pointing to where we are today, the orange line, versus when we had 7.10 interest rates, back where the black arrow is pointing. And if you see that, that is, we're actually, the 10-year Treasury is less than where it was back then, which has a little bit to do with the banking tightness and banking crisis that we've had. It's not like the crisis like the Great Recession or anything like that, but there is further tightening, and the pricing got a little worse after the bank started folding just a little while ago in March. So it's kind of broken. You can see where we're at right now, but this is very similar to the last slide that we saw, and we could see that there's this range that we've been staying with the 10-year Treasury, and that translates to 6.5 to 6.75%. And you can see within the last couple of weeks, it just kept on going higher and higher with all the uncertainty around the debt ceiling and what it can do to mortgage rates in the financial markets. And this is what I was referring to, this love affair between the 10-year Treasury and the 30-year mortgages. You can see that the average going back over 50 years is 1.71 above wherever the 10-year Treasury is. And the 10-year Treasuries are that blue line. The red line is our 30-year mortgages. And you can see that, and I'm pointing in the middle of that. That is exactly 1.71. Now on the right-hand side, I'm showing you that same average of 1.71 and where we are today. The spread is gigantic, and the reason the spread is that big is because all servicers, everybody out there, they don't like all this risk, and there's a lot of risk out there. There's a lot of uncertainty, so that plays into it. Another thing is that banks like to make a profit. Of course, they're in the business to make a profit. All the servicers, everybody that is tied to when loans are made, they're all in it to make a profit. But if they think everybody out there is going to refinance as soon as rates start to drop, they want to make more right now because they have to hold on to it long enough in order for them to make enough money. So if people are going to be refinancing quickly, what they want to have happen is they want to still make a profit. In order to make that happen, they're actually charging more. And that is another reason why this spread is as wide as it is. But let's get back to that debt ceiling. And the debt ceiling, you can see in time, we've actually been doing this since 1917. This was enacted, where the debt ceiling is negotiated, and you can see how many times it's been negotiated over time. It is a bunch of times that it's been negotiated. It keeps on having to the legislature, the Congress has to come in and decide to increase the debt ceiling, and it's happened over and over again since 1917. The last time it happened in a major way was in 2011, and in 2011 that is where when we have one party in Congress and another party in the presidential administration, it tends to be this political hot potato where they utilize this as a negotiating tool to get some of the stuff that they're looking for done. So unfortunately, that's the political side of what's going on. And now it's bleeding into the overall economics right now until this debt ceiling gets resolved. And across the United States, you can actually, around the world, there are only a few countries, and Kenya is going to get rid of this debt ceiling, and Denmark made this artificial debt ceiling so high that they're not going to hit it anytime soon. It's pretty much the United States is the lone soldier here. That is the only country around the world that continuously argues about this and makes it a political thing rather than something that automatically happens. And you can see the debt limit as a percentage of the GDP. That's another way of doing it. You can see the blue countries that do that. EU actually does that, European countries. But then you could see on the right-hand side, that is no debt limit at all. And that's the vast majority of countries around the world, including the United Kingdom, Japan, China, some of the bigger ones in Russia. So we have one of those unique situations where we actually turn it into something that is negotiated on. So wanted to talk about 2011. 2011 was when Snapchat was first rolled out. And what happened in 2011 is we had the same issue with the debt ceiling. Matter of fact, going past it, and the United States credit rating actually went down. And after they resolved the debt ceiling issue, which was at the end of July of 2011, interest rates dropped all the way from 4.7% to 4.1%. That is a healthy, gigantic drop. And that just shows you how much angst is built into the system when we have this debt ceiling argument that's out there, that once this is resolved, markets kind of then go back to normal. It won't go back to normal immediately the longer we wait. So hopefully we get this resolved sooner rather than later so that we can go on to, this is not the time to be dealing with this kind of an economic factor. It's really, right now, there's enough going out there where there's a lot of people who are saying we're on the verge of a recession. And so to add a little bit more economic angst, this is just not the best timing for all of that. So I wanted to talk about mortgage rate projections and where they think that they're going to go. This is Fannie Mae. They do this on a monthly basis. They had to revise theirs up. Now, 6.4% was the average rate for 2023 Q1. For 2023 Q2, the average rate will be about 6.4%. And in 2023 quarter 3, it will be 6.2%, and fourth quarter will be 6%. These are their projections. Now, as far as what they think for next year, 5.8% in the first quarter and 5.6% in the second quarter. And you can get the gist. Third quarter, 5.6%, fourth quarter, 5.4%. Overall, most economists agree that we're probably looking at interest rates coming down as the economy slows, with all of these short-term rate hikes the Fed has done, going from 0 to 5.5% in such a short period of time that is going to affect the overall economy. And as a result, we will have mortgage interest rates that fall, which will lead to more demand down the road as well, which will make our market even crazier. But if you want to know exactly where rates are going to go and when they're going to go lower, or exactly time it perfectly, I don't know. It's been a very humbling experience being an economist, and all economists are having a really hard time predicting exactly where they're going to go. You can kind of talk about ranges. That's the best way to do it. But if you want to know exactly where they're going to go, well, shoot, my recommendation is to throw darts at a dartboard full of interest rates and have some beers and enjoy yourself on trying to figure out exactly where interest rates are going to be. So the Southern California housing market has been absolutely nuts, and it is on the verge of insanity is where it's at right now in many, many markets. This is the spring market. This is typically when supply rises and demand rises and peaks. However, this has not been a real typical year. It's still the best time of the year as far as the amount of demand and pending sales are out there, but we're not really getting that big, gigantic supply rise. It's not happening, and we're not going to get it, it looks like, at all this year. And right now, we have this overwhelmingly low supply. It's catastrophically low, and it's trumping the affordability issue. Right now, if the interest rate's at 7%, if they stay here with duration, that could be a problem for the housing market. But it most likely is going to get resolved in the short run, and after it gets resolved in the short run, we'll watch those interest rates float back down, and as the economy cools more, we'll see interest rates float down a bit more from there as well. So this low supply is trumping affordability, and most likely the higher rates aren't going to stay with duration. They're going to come down as soon as we get a resolution to everything. But this is where overall the inventory is right now today. In drawing a line across, you could see the only time that it was even lower was during a couple of those COVID years, and it started off last year, 2022, with a very, very low level of homes, but really surged a lot higher. That is not what at all is going to happen this year. Today, we're at 18,460 homes on the market. It only went up 1% in the last 2 weeks. Not a very strong clip. Less than a couple hundred homes for all of Southern California. Last year, it was at 18,976. So there's actually more homes on the market. I don't know why it says 28% more. That's funny. Actually, I think 18,976 is the incorrect number. If you look at it, it is over 20,000 at this time. So apologize for not having that correct number there, but it was 28% higher than where we are today. The pre-COVID numbers, this is accurate, 38,677 in the 3 years prior to COVID, 2017, 18, and 19. That's 110% higher than where we are today. So that means double where we are. So last year was the orange line. You could see how quickly it was going up. It was going up at an incredibly fast pace. And right now, it is going up, but it is going up at a very slow pace, and that is a real issue. The reason it's an issue is because the inventory typically peaks sometime over the summer, typically between July and the third week of August. And why does it peak then? That's because more homes come on the market during these summer months. But you have to understand, demand actually is typically already peaked. It cyclically peaks during the spring market. And the same typical number of homes come on the market, and as a result, the inventory grows during the summer months and then peaks sometime during the summer. Well, we're going to peak during the summer, and it's going at such a slow pace that once we peak, there's not that much room for it to grow from here. And once it peaks, it'll start coming down for the remainder of the year, and then we'll really fall at the end of the year. We're actually following the 2021 curve, which set up the record low number of homes to start the year in 2022. And that's kind of what we're seeing right now. It looks like we're going to have a catastrophically low supply at the start of 2024, which will start a hectic market, but there's just going to be no inventory. No inventory means fewer pending sales, which means fewer closed sales, but a hot market. So, and that's kind of the predicament that we're currently in right now. Now, I've mentioned it before. Homeowners are hunkering down. They're staying in their houses. Many of them can afford to move up, and it still could be in their budget. But the problem is interest rates are so high that, yeah, it is in their budget, but they'll be paying so much more because they're locked into with these great interest rates when over 70% of everybody that has a loan here in California has a mortgage rate at 4% or lower. It's just going to preclude a lot of people from selling their homes. If right now there's 7% interest rates and they're locked in the threes, that just doesn't make sense to a lot of people. And can they afford it? Perhaps. Many can, but do they want to pay that extra amount? They're thinking, hey, you know what? I'd rather go on vacations. I'd rather go out to eat at restaurants, all that good stuff. So that's why we're seeing a lot of homeowners staying where they're currently at. And you could see it in the numbers. I've talked about it before. Initial COVID lockdown, fewer homes came on the market compared to the 3-year average on a monthly basis when we first went into COVID. And you could see in 2023, for the first 4 months, which is on the right-hand side, 40,000 missing sellers. That's 42% fewer for sale signs in the Southern California market. And this also translates to all the markets that I'm following. It translates to Vegas, to Phoenix, and to the Bay Area. So this is, and it's a phenomenon across the United States. Fewer homeowners coming on the market because they're locked into such great rates. And if you actually extrapolate this out further, you can see that we're going to be missing, from based upon January through April, the same percentage fewer homes come on the market on a monthly basis. We're going to miss 114,500 missing sellers for 2023. That's that muted dotted blue line. So we have this low inventory, and that is what's going on in the housing market. And it's going on in the housing market, not just here in SoCal, but across the United States. And I've seen it with Altos Research's numbers and NAR's numbers. So there's a bunch of different places that aggregate the total listing count across the United States, and you can actually see it in the numbers when you're looking year over year and even prior to COVID. So if you see this is Southern California. Well, let's go back. Southern California demand. In Southern California demand, I draw a line across, and it's pretty muted where it's at right now. It should be all the way in where the blue peaks are, because it typically peaks during the springtime. We may have hit an early peak right now. Well, it's not early, it's during springtime, and it may peak a little bit later as well. But here's what's going on in as far as demand. Demand is a snapshot of 30 days of escrow activity, pending sales. Today we're at 11,662 pending sales. It was down 2%. Not a giant number down, but still down. And last year we were at 14,904, 28% higher. That's the orange line. But you can see they're actually squeezing closer together from the blue line to the orange line. They're getting closer because interest rates they were just hitting 6% in June. We're higher than that right now, but you could see what it was doing to demand as interest rates were rising. Pre-COVID, we were at 17,782, so a lot more pending sales. More pending sales. Now, with this demand curve would look, this chart, we would see that blue line would be a lot higher. It would be a lot higher if we had a couple things that were different. A, we have interest rates that are lower. But even if we had interest rates that are lower, the real issue right now is not the high interest rates. The real issue that's going on right now is we don't have enough homes on the market. So buyers are bumping into each other, and as a result, we are placing fewer in pending contracts together. There are fewer of them. So you really can't buy what's not for sale. And so what that translates to is fewer pending sales, which translates to fewer closed sales as well. And where are we going from here as far as demand's concerned? It's going to be pretty flat until we get to around September, where it will fall, and it will fall even further as we get into the holidays. That is very, very typical. There are also fewer homes coming on the market during the latter 5 months of the year. Pretty much actually starting in September, so the last 4 months of the year, there really are fewer homes coming on the market. But if interest rates fall down enough, it could invite more homeowners to actually place their homes on the market, as well as if interest rates fall down enough, which is what we anticipate, that interest rates will get down to about 6%, maybe even under that as the year progresses. We could get a spike in demand if that happens. I imagine that would happen at the end of summer, right around the August-September timeframe, and we get a little bump in demand. And then there will be more sales, more pending sales, which would translate to more closing sales as year over year, comparing 2023 to 2022. So what is the speed of the market? The speed of the market is you place your home on the market. When are you opening up escrow? You can see where we're at today. It's actually slowed down a little bit. You can see on the right hand side there's just a little, it's starting to go up a tiny bit, and it's still relatively low compared to where we were for all of the expansion years, except for the very start of 2013, all the way through until we hit COVID about July of 2020. So that just shows you how hot the market currently is right now. And today we're at a 47-day expected market time. That's the market time right now. And last year at the same time we were at 42 days. This is going to converge and go right past where it was last year. In 2 weeks, there will be the expected market time will be higher than where we are at in 2023 for all of Southern California. And pre-COVID was at 66 days, so slower than where we are today. So if you were in the market prior to COVID and you're in the market today, it would actually feel hotter, which is why we're presently dealing, when you have an expected market time that drops below 60 days and drops, this one's even below 50 days, at that point we have buyers bumping into each other. We have multiple offer situations. We have bidding wars, which is like an auction, like as if we were New Zealand or Australia or the United Kingdom. And we have sales prices going above their asking price. California Association of Realtors last week, they revealed the fact that the sales to list price ratio is at 100%. And there are 43% of all closed sales for the month of April that closed above their asking price. Prior to COVID, the highest ever that we saw was 40%. 40% of the market sold above their asking price. In this market where we have 7% interest rates, we still have a 40%, 42% or higher, more than 40%, sales above their asking price, which just shows you how incredibly hot the market currently is right now. Now, Southern California expected market time, where are we going to go from here? It's going to be pretty flat. It'll slow down a little bit as the year progresses. But like I said, if we have interest rates that fall towards the end of summer, what we can see is that the expected market time, because the supply issue will not get much better, but demand will grow. And as a result, we could see expected market time dip even further lower and lower. Now, I do want to go over Los Angeles is at a 51-day expected market time. Last year at this time was at 45 days. Orange County is at 39 versus last year was at 38. Riverside at 49 versus 41. San Bernardino at 56 versus 50 last year. San Diego at a 35-day, which is extremely hot, 34 days last year. And Ventura is at 35 days, 44 last year. So you get how incredibly hot the market is. It's so hot in many of the markets, with the exception of San Bernardino. San Bernardino is right at 50, but there's still in many, many cities, I know because I track them, that they're receiving multiple offers and bids above the asking price, all that good stuff. This market overall is unhealthy. It's just, it's not one that that anybody should root for. You shouldn't even root for this as a homeowner. It doesn't make sense. Not a lot of people are being able to play. There are a lot of homeowners staying put. A lot of buyers aren't able to purchase, and there are a lot of fewer pending sales, and there are a lot fewer closed sales, which affects everybody. Buyers, sellers, everybody tied to the real estate industry. The only thing that's going to fix this is for mortgage rates to come down. So the Fed really put a stop to the housing market in terms of sales. Now, across the United States, you can actually see, this is Freddie Mac's house price index. We've gone over this before, but in the United States, it's up 1% year over year right now. It's down 3% since June, and it's up 2% month over month. Now, a lot of people are creating a lot of hype about this year over year. It's about to go negative on many of these house price indexes that these various entities do. I like to follow the Freddie Mac house price index, but there are plenty of them out there. A Black Knight's another one I like to follow. But in this should have said California. I don't know why it says United States, but you could it's up 1% year over year, down 3% since June. And even in California, where everything got hit quite a bit, it's up also. It's actually up 2.5% month over month for all of California. And for that index, the Freddie Mac Home Price Index, Orange County and LA combined went up 3%. They did the best out of all the metros across the United States when everybody's talking about how the West is being hammered, but on a month-to-month basis, they're appreciating at a pretty rapid rate. And you have to understand, up 3% for the price ranges that are in the West are a lot higher than the rest of the country. So these are big gains that are making up for the losses since peaking back last May. So, and that's kind of what the trend is right now because of the lack of supply. So if you want a copy of this, you need to be a subscriber. You have to be a subscriber to the Housing Report. You can go to reportsonhousing.com to subscribe. The most recent one that came out is called Hype versus Data. I go over many different facts that you can't refute. People need to pay attention to the facts rather than listening to all the hype on social media and everywhere else. This is real data and facts so you can make great decisions. And if you want to be a subscriber to the Housing Report, go to reportsonhousing.com and click on subscribe and enter the coupon code SoCal for a free month. Well, that's it. I think we did another housing debrief. Hope you have a fantastic finish to your week, and we will see you on the other side.